Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and India has got caught up in the global storm. The Nifty right now, as we speak, is just about hugging the 22,000 mark. Up and down below that level. It's a fall of 4%, 900 points lower on the Nifty. The Sensex is down close to about 2,800 points. Intraday, the Nifty even went down to levels of 21,743. We also breached our March lows. Look at the knock on the mid and small caps. 4 to 5% gone in the mid and the small cap index. The advanced decline ratio stands at 1:30. When was the last time you probably saw this kind of an advanced decline ratio? May have been around the time when COVID just hit us and there was panic all around. But 1:30 is the advanced decline ratio right now. And it's pretty much gloom and doom across the Asian markets too. Look at Hang Seng, 10% gone on Hang Seng. So that's leading the losses across the Asia-Pacific region. Shanghai is down about 6.2%. Taiwan, Straits, Nikkei, across the board. Deep cuts is what we're staring at. And, for so long, we were talking about how far away we are from our 52-week highs, right? Like 10% gone, 15% gone. And now we're very close again to our 52-week lows, just about 3% from our 52-week low, which was 21,281 that we hit on the 4th of June. And individual sectors, whether it's auto, metals, IT, are already today trading at their 52-week lows.
And the majority of the fall has happened just in the last 3 to 4 trading sessions.
3 days, yeah.
Exactly. So, Thursday we actually saw a very, very mature reaction. We didn't see a very large fall. But Friday and today, the majority of the fall has been seen, especially the small cap index, as you just pointed out, down over 5%. Which are the sectors that are seeing the maximum pain in today's trading session? The Nifty IT index continued to witness significant pressure. The Nifty Pharma pack, it's seen a bit of a recovery, but again, it's one sector that's seen a deep gash today. And the entire metal pack, all of the metal stocks are, metal prices too have come crashing down. And the metal index too under significant pressure, down over 6%. One particular stock that stands out in terms of weakness today is actually Trent. It's a 28% growth that the company has seen as far as Q4 top line is concerned. But again, the street does not like the fact that it's actually lower than what historically the company used to deliver. And the stock that was a relative outperformer going into this particular Q4 quarterly update today has seen significant amount of the recent outperformance give out. And lastly, few pockets of relative resilience. The FMCG pack, it's seen as a pocket of safety, also benefits from lower crude oil prices, margins are protected. So the FMCG pack, so if you look at names like Marico, look at names like HUL, those stocks haven't fallen as much. Some of the crude sensitive names like Asian Paints, HPCL, BPCL, all of them have seen a bit of intraday recovery. And two stocks that stand out, delivery on the back of news flow, good acquisition there. That stock, at one point of time was near the day's high at 1.5%. And Torrent Pharma, a stock or a company that doesn't have too much exposure to the US markets, actually that particular stock, significant outperformer as far as the pharma pack is concerned. But nothing too much to write home about. It's a deep gash, a 5% over downtick as far as the small cap index is concerned.
Indeed, so this is the best time to get you what global opinion is following the tariff-led rout. So let me start with Nomura, where Chetan Seth Nomura says, US stocks are approaching technically oversold levels, but valuations are not yet comforting enough. Overall, they say they continue to recommend defensive positioning on Asia ex-Japan stocks unless US policy course reverses. He says they're particularly cautious on Taiwan, Korea and Chinese equity, given the clear escalation seen in US-China tensions, while they do consider India should be the preferred choice in the region for investors who are looking to buy the dips.
Well, on the other hand, Morgan Stanley's Jonathan Garner recommends moving portfolios to a fully defensive orientation, given signals over the weekend of commitment from the US administration to sweeping tariff implementation. The US economics team at Morgan Stanley has noted that the risk of recession has increased materially, while the Fed is less likely to arrive early in their view, given tariffs as well as cost inflation pressures. They recommend bond proxies, including utilities, telcos and staples, while reiterating underweight stance on semiconductors, hardware, autos, and cyclicals broadly. Favored trades such as gold and defense may pull back on positioning, but they would recommend buying into the weakness.
Okay, earlier today we had a chat with Matt Orton, Chief Market Strategist at Raymond James Investment, to get his view on India's standing on the US tariff issue and more. Listen in.
there's a potential that tariffs could increase depending on retaliatory measures that are taken, but tariffs can also decrease. And I think the idea of bilateral trade dealers are going to be very, very important. I think India in particular stands in a very, very attractive position. Gold as well, and gold miners, which sold off significantly on Friday, I think can be a tactical opportunity for investors because they're levered to gold. It's not part of the tariffs that are put in place right now. And so I think that's an area that investors can also find a little bit of protection in the overall market.
Well, that was a very interesting opinion coming in. But another important voice joins in now. Mark Matthews from Julius Baer and Company joins us now. Thank you so much, Mark, for joining us. First up, give us your views on what's transpired, since Friday. Friday equity markets worldwide has taken a hit. Asian markets today have seen a deep gash at these levels. What do you, number one, make of the entire tariff scenario? And number two, would you turn buyers at this level?
First thing I will say is I got it totally wrong because I did not think that the Chinese would reciprocate. They've effectively increased their tariff rate to almost the same as the United States on American imports. And that was really the catalyst for the flash crash on Friday. So if you add Thursday and Friday together, 10.8% decline. Historically, that kind of decline is extremely rare. It only happens in black swan events. There have been 19 of those since the S&P began in 1923. And if you exclude the great crash of 1929, actually in 11 of the 14 times when you had a decline of this magnitude, the S&P was up 12 months later, which is pretty good odds. That's almost 80% chance. So I know it feels like the bottom's falling out from under us, and it really is. But I will just say that there have been plenty of other times that we all can think back on when there was no light at the end of the tunnel. And there was actually, it's just we couldn't see it at the time. So we have no way of knowing what the world will look like 6 months from now, 12 months from now. But I'm just telling you that when you do have that kind of flash crash, history's on your side for the market rising. And by the way, it is too when you look at where we are today in terms of stock market volatility, investor sentiment readings, deviation from the moving averages. So I think that the market is probably still going to go down, but I can't believe that the Americans and the Chinese are going to play this game of chicken for very long because both stand to lose. I think the Chinese now feel they have the stronger deck of cards, and maybe they do, but they actually do rely on a lot of things that they buy from the United States that would be very difficult to source from other places, like soybeans. The only two major soybean producers in the world are Brazil and the United States. About 30% of Chinese soybeans that they consume are from the United States, and the Brazilians can't make any more. They're already maxed out. Integrated circuits, airplanes, jet engines, chemicals. The list is actually quite long of things that the Chinese need from the United States that are going to be a lot more expensive with a 50% tariff. And the same works in reverse for the United States. So my sense is that hopefully common sense will prevail and we will get a recovery. But there has been deep damage. So even if we do have a recovery, I think maybe we could bounce by half of what we've lost. And then we just have to, lick our wounds and build a base because there's no doubt there's been very deep damage to a loss of trust among countries in the world, loss of confidence among businesses and investors.
That heat map should once again come up for our viewers. All 50 Nifty stocks are in the red. Your best performer is in Asian Paints, which is down only about 0.5%, and that's because it's benefiting from the fall in crude prices. Brent, remember, is at $64 per barrel, but all Nifty 50 stocks. And plus, Asian Paints has also been a big casualty of competitive pressures, and it's fallen close to about 30% from its 52-week highs. And that today, with a 0.5% fall, is your best performer. On the way down, in terms of top loser, it's Trent, 17%. Then you've got Tata Steel, Tata Motors, 8-9% gone on these individual stocks. Mark, hi. Morning. You called it a game of chicken between US and China. The question is, who blinks first right now? But do you get a sense the way, Trump has been defined in his stance? When asked about the pain in the stock market, he's like, I don't want anything to go down, but sometimes you have to take the medicine. So given this kind of posturing, do you think this uncertainty is likely to be prolonged? He's willing to bear the pain? And what would the next 6 months look like, to your opinion?
I really can't forecast them, and I can't say when either side will pull back. It's just impossible to say. But all I will say is that common sense would have it that they mend fences. And unfortunately, there are many instances throughout the history of humanity when common sense has not prevailed. So I could be wrong, but I do notice that many countries are negotiating with the United States. China's the only one so far to have reciprocated to this degree. And so the longer it stays, with this stance, the more it sort of looks separated from the rest. I don't know. I can't answer the question. Sorry.
Mark, we get that point, complete uncertainty. It's so tough to form an opinion. But once again, what we'll try and do is we'll try and get your take. As far as the Indian markets are concerned, do you feel India, within the emerging market scenario is relatively insulated, given the fact that the effective rate of tariffs for India is lower compared to China, Vietnam, where we compete with in terms of exports to the USA? In that context, how do you view the Indian equity market? Would you turn a buyer at this level?
Well, unfortunately, I can't give you a straight answer. Once again, there's so many moving parts. I mean, on the one hand, the economy is quite well insulated to what's going on in the rest of the world. The collapse in the oil price is good for India, allows the RBI to cut rates more. The foreign ownership of India is at a very low level, so foreigners don't really have a lot of stocks to sell. But I guess what concerns me is it has been a very bullish market over the last 2 years. It did go up about 50% in 2023 and 2024. And to the degree that retail investors start losing money, then it could become a bit of a snowball effect. In other words, if you can imagine a snowball when it's rolling down a hill, starts off small, but the more snow that clings to it, the bigger it gets, the faster it rolls. And so the fact that retail investors are very long the Indian market is somewhat, of a concern. So I'm giving you a whole bunch of different stuff, but I would have said just fundamentally India should do better than the rest because foreigners own not very much of it, and it is an economy that is quite insulated from all of these crazy things going on in the world.
So many things in India's favor, right? Crude prices are down. The dollar index has retreated significantly. India, which had preceded the fall with a 16-20% kind of a decline already seen, valuations today are far more reasonable, 17-18 times on the frontline index. Plus, the budget tax cuts will help consumption in the domestic economy, and relatively, the tariff picture for India should be a lot better. But, Mark, getting back to the point about confidence, a lot of, investors too seem to be worried about that. Let me just quickly pull out this tweet that billionaire investor Bill Ackman, who had endorsed Trump during the election, says, as he tweeted, America is heading towards a self-inflicted economic nuclear winter as a result of U.S. President Donald Trump's tariff policy rollout. He says by placing massive and disproportionate tariffs on our friends and enemies alike, and thereby launching a global economic war against the whole world at once, we're in the process of destroying confidence in our country as a trading partner, as a place to do business, and as a market to invest capital. He adds, when markets crash, new investment stops, consumers stop spending money, and businesses have no choice but to curtail investment and fire workers. And it's not that just big companies will suffer. Small and medium-sized businesses and entrepreneurs will experience much greater pain. Almost no business can pass through an overnight massive increase in costs to their customers. And that's true even if they have no debt. And unfortunately, there is a massive amount of leverage in our system.
Well, that's right. Bill Ackman, in fact, goes on to say the president has an opportunity on Monday to call a timeout and have the time to execute on fixing an unfair tariff system. Alternatively, we are heading for a self-induced economic nuclear winter, and we should start hunkering down. May cooler heads prevail. Well, with that, we'll now slip into a quick break. Up next.
Okay, just one more question, Mark. In the past, whenever we've had crisis, and you referred to it at the beginning, that, we've had these flash crashes in the past, there was a, fixed policy response, whether it was to COVID, the government would reflate the economy, even to financial crisis. This time, now that it's government-induced, what could be the kind of policy response that we see? How do you get out of this mess?
One would be from the Federal Reserve, of course, but if the Federal Reserve doesn't want to do that because there's going to be an inflation shock, then I would say the onus has to be on the government to withdraw these tariffs. The billboard that Trump showed in the Rose Garden lawn was just full of all kinds of numbers. It was crazy and complicated and didn't make any sense. And for an economy this size, the largest economy in the world, to recalibrate its trade flows and its supply chain so quickly, it's simply not possible. So something has to happen. I absolutely agree. And my bias would be that they will somehow withdraw these tariffs, and largely through negotiating with other countries to bring them down mutually. It has to happen very quickly. Otherwise, there's no doubt the shock on the economy will take it into a deep recession.
Mark, one question. As far as healthcare and pharma is concerned, we still don't have clarity on the quantum of tariffs that are expected to come in. Now, India, in terms of the actual quantum, doesn't really export too much into the US, but in terms of volumes, it's quite large. Also, there are worries that US may not be able to set up manufacturing of drugs, as quickly as, the tariffs are put into place. In that context, what is it that you anticipate in terms of healthcare and pharma for tariffs that, for exports into the US?
I don't have, I'm sorry, the knowledge to answer that specific question. I just can't. But to the degree that India sells generic drugs into America, then I think those are not the kind of drugs that America deems of strategic importance, that they're talking about developing their own capacity in case, there's some kind of war or something like that. I'm sorry, I don't have much more to add apart from that.
Are you in the camp that believes we're going to see many Fed rate cuts this year, or not? Worried the Fed may not, being worried about the inflation shock?
I suppose that if we have a very deep dive in economic activity, there will be a Fed response. But the problem is that the tariffs are going to be inflationary. And so just looking at an iPhone, for example, the cost of an iPhone should go up about 30% unless the company Apple decides to, reduce its margins dramatically. So there'll be a conundrum for the Federal Reserve because they're going to have a recession and inflation. I guess, if I think back to the last time that happened, it was the early 1980s with Paul Volcker, and what the Fed did was it raised interest rates. It didn't cut them.
Thank you so much, Mark, for joining in, giving us your view on a variety of subjects in this particular developing story as far as tariffs across the world are concerned. Thank you once again. Well, we now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. Take a look at the commodity prices, and we've seen sharp declines coming in for this one as well. And it's slightly unnerving because commodities are raw materials driving global economy, and the kind of tangible commodity price declines that we've seen in last 1 week or so have been quite on the sharper side. Crude oil prices are on your screens, and we've seen nearly 3% of a decline coming in right now. This comes in on the back of 7% decline on Friday. On a weekly basis, we're down by 11% for the crude oil prices. And for this year now, we are trading at around 2021 lows from the month of April in sense of crude there. Well, a couple of factors here. One, of course, is all about tariffs and the sell-off expectation that you could be looking at demand getting impacted. The second is about OPEC and allies increasing production 3 times more than what the street was anticipating. It also is about Saudi Arabia cutting official prices to its Asian consumers for the month of April and May as well, to almost lowest in 4 months. And it's not just about the crude oil prices. If you look at the gold prices, the sell-off in other asset classes has led to that being set off by selling gold as well. And very huge volatile moves is what we've seen in case of gold as well. Remember, it was last week that we saw an all-time high of 3,167. We saw nearly a low of 2,967 into the Asian markets today, and currently trading at around 3,040. So very, very volatile moves coming in. In matter of 24 hours, it's about $80 to $120 of a move in gold is what the markets are dealing with right now. I also want to talk about what Powell said, and he said that Trump new tariffs are larger than expected, and the economic fallout, including inflation and slowing economic growth, is something that cannot be ruled out, and that in turn perhaps would be supportive for gold going forward. But one area that has seen constant declines and sharp ones has been metals as a sector. Multi-month to multi-year lows coming in for many of them. Copper prices, for one, are trading at a 3-month lows. You have nickel prices trading at 4.5-year lows. If you look at zinc prices, that one is at a 9-month lows. Aluminum is trading at a 7-month lows as well. So clearly, with what's happening between US and China in sense of retaliatory tariffs, does impact markets there. But joining us now is a very special guest to take us through all of that volatile moves is Jonathan Bharat, CIO, ETO Markets. Jonathan, hi. Difficult times, and Monday morning is no different with the kind of sell-off that we've seen in various markets. I want to start with metals first, because that's top of in sense of headlines. The sell-off in copper down 12% in last 4 or 5 trading sessions. Aluminum, zinc for that matter as well. How do you see the markets right now? Is there any side that you see when the markets could stabilize, or this is a new norm, at least for the very near term?
Manish, good morning. Look, I think it's a new norm, to tell you the truth. I think it's going to take a long while to get out of the current malaise that we're in. And we really don't know how companies and countries are going to respond to the tariffs unless we see someone backing down, unless we see Trump back down, or a lot of negotiation very quickly. But you also got to think that copper was trading close to those record highs and at record highs, and then all of a sudden we've had a short, sharp sell-off. So we actually had a market that was extremely long, and now people are sitting on positions which are perhaps the wrong levels. So I get a sense that, we've got pretty important highs in place for a lot of the metals, and I think we're continuing going to track lower from here until we get some positive signs that China's starting to pick up in terms of its economy, or we start to get some back down in terms of the tariffs. But at the moment, it's still a bit foggy out there, but I think the market will be on the downside for some time to come.
And how much of a decline are you anticipating, Jonathan, from these levels? Is it 3%, 5%, 7%?
Well, if you think where LME copper is at the moment, I think it can. I think one of the big areas of support is around that 8,500, but I wouldn't be surprised to see around that 8,000, perhaps a little bit lower. But that's going to take time. But I do think that, yes, about another 10% on the downside is something that we can realistically look at.
Now, the 10% down in case of metals there, but what's your sense on crude oil prices? Because we are at 60 and below 60, and the markets are now talking about 55. I mean, that clearly happens when you see a one-side sell-off. There are more lower sides that open up. Are you as bearish on crude?
I am bearish. I think when oil's been hit by a few things, as we know, a little bit of demand destruction is a story, and as you correctly pointed out, OPEC increasing supply, and also some pricing from Saudi Arabia, which is more of a discount. So there's a lot of dynamics there. I think OPEC perhaps acted too early in terms of what they were trying to do. And I think you'll find that there will be an about face there pretty soon just to stabilise. Remember, oil in itself, we know how volatile it can be. And I think if we can't pick up that demand story somewhere along the line, I think once again, we'll see prices continuing to fall. And we know when oil is on one way, one directive, she can go pretty quickly.
Also on gold, and this has been very, very volatile, of course, getting stuck in sense of a set-off in what we are seeing in other asset classes. Further downside is what you're anticipating, because markets tell us that you could be looking at some more profit-taking, 2,500 kind of levels coming up, but then there's 4,500 as well in next 2 years. Big ranges coming in here. What is your sense, your levels for the near term and slightly longer term?
Well, over the last week or two, my trading P&L hasn't been that good because it's been exceptionally volatile. Looking for it to trade higher and then all of a sudden that reverse. I would have thought with that instability that you would actually find more investors going to gold. But as we do know, when you get margin calls, when you get a lot of volatility, people tend to sort of go out of gold and they look so that can shore up their other assets. And I've noticed that has been a trend for quite a few years. The volatility is there, people go out. But when we can see that there is a track that suggests things are going to normalise, I think you'll find that gold will start to pick up. Remember, central banks have been in there for quite some time, and I think they'll actually see this as a golden opportunity just to continue to buy, just to continue to shore up their own books. So I do think that eventually we'll find a low, and then I think you'll find that gold will pick up. Remember, the US dollar index has been high for some time, and I think if the US have a parallel policy to stimulate their own exports in the weight of the tariffs, then it makes sense to have a weaker dollar regime. So, and I think that will eventually help gold. So at the moment, a little bit lower, but I do like the dip on it.
Right. Jonathan, this is Vivek joining in. One question, you spoke about how, there is probably an urge to keep the dollar index at slightly lower levels. At this point of time, how do you see metal prices and especially, steel prices, given the fact that when you're looking at equity markets worldwide, and especially in India, metal stocks have taken a bit of a beating, be it copper stocks, be it companies that make steel, all of these stocks have seen significant selling pressure. How do you see steel prices and how do you see metal, prices pan out from here on?
I think at the moment we've got to go through this adjustment phase. I think it's unfair to be able to say 6 months what will it actually look like, what will prices look like. And the reason because that is we're going to go through a period of volatility where we've got to see how these tariffs do play. If you were a betting person, you'd say, okay, if you keep tariffs on and you keep tariffs as high as they are, that's got to be inflationary, that's got to be bad for the economy. Therefore, base metals and other metals, steel prices should actually come lower. But having said that, in China, you're looking for that economy to turn around. And if that economy starts to turn around, then they obviously need the support of the metal side. So if anything, still need a little bit more time in terms to work that out. I think if China can pick up, remember we've got inflation figures out this week. If they're a little bit more robust and we're out of that stagflation, I think that will support the steel prices. If in fact we see inflation and it comes out and it's still quite benign, then that's going to see a negative effect to it. So China's the big thing, but also how we digest with the tariffs and how that plays out in terms of the global demand for the commodity or commodities. We just got to need a little bit more water under the bridge.
Jonathan, clearly, the current market sell-off and especially sell-off across commodities is a knee-jerk reaction as far as, the tariffs are concerned. Just a couple of months ago, we were actually talking about the aluminium markets being in a bit of a deficit. So do you think, supply demand there has changed to an extent to which we are seeing, almost 10% downticks daily?
Well, I think what's happened is that there's a change dynamics. If we looked at a deficit, like in sometimes with copper, we also feel there's a deficit there as well in terms of supply. But all of a sudden the economy slows down, then it's not a deficit. And then it sort of balances itself. I think the supply side, remember there's a whole new supply side dynamic which has been changed. People are trying to find new markets. People are trying to find, markets they can buy from and they sell to. If you take the US out, or parts of the US economy out, and you try and filter it to other countries, that's going to take time. Contract's going to take time. And I think it's within that time period that we'll see changes. But at the end of the day, supply side is important to where the metals trade. And at the moment, the market is focused on whether or not we're heading into a recession, how deep that recession will be, and as a result of that, metal prices should remain under pressure.
Much uncertainty. Thank you very much for joining in. It's almost gotten impossible to predict. Thank you for trying. Let's slip into a break. On that note, we'll come back and discuss market technicals. Soni Patnaik from JM Financial Services joins in with her top trading bets.
baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Welcome back to Trading Hour. Well, there's been a little bit of a cool-off as far as the selling pressure is concerned. The small cap index has recovered a little bit, and so has the mid cap index. But we'll now get you some important opinion. Sanjeev Prasad of Kotak Institutional Equities highlights 3 points that create large uncertainties about the Indian markets. He says the imposition of high and varied import tariffs by the US on its major trading partners, the different responses by other countries so far, and the sharp sell-off in global markets create large uncertainties about the Indian market. He adds the response of the countries to the US reciprocal tariffs and the behavior of investors will determine the course over the next few weeks. He goes on to say that a section of the street may want to believe that India could benefit from global supply chains moving back to India due to relatively lower tariffs on India. They would caution against this, noting the complexity of global supply chains, the dilemma of companies to make decisions in a very fluid environment, and the response of countries to retain manufacturing through appropriate trade deals with the USA. In fact, earlier today, we spoke to N. Jayakumar, Group CEO and Managing Director at Prime Securities. Let's listen in to excerpts from that conversation.
Important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it'll take a while. Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are 1 or 2 sectors that are affected in India, which I think will come out unscathed.
Okay, let's 1 or 2 sectors may come out unscathed. To catch the full interview, we will be putting up more from that. We'll be putting out excerpts from that conversation. But Soni Patnaik from JM Financial Services is now with us for a quick check on the market. Soni, good morning. What does one do when you're faced with a 900-point fall on the Nifty, and all indices are down by a similar amount, some more, but none spared?
Hi, good morning, Rima. Vivek, thank you so much for having me on your show. So I think today, of course, it's quite difficult to navigate the markets. It's not exactly indicating a recovery mode from current levels. You can see aggressive call writers positioning themselves anywhere between 20,500 to 20,300. So there's a possibility that as long as those levels are not taking out, a sell on rise structure may be seen, and as Nifty approaches those levels, selling pressure may intensify again from those levels. So I think it's going to be this volatile, especially when India VIX has actually shot up by 50% today above 21. There's a possibility that it can actually test 26 to 28% levels. So, as long as the VIX is going to remain high, markets are going to be quite volatile. And the best strategy could only be to hedge the positions and look for both a buy and a trading selling ideas as a strategy from sector specific or stock specific, rather than just playing out in indices.
Soni, any individual trades for the day, or are you sitting out today?
I think, Vivek, I would like to sit out, but however, there are two stocks which one can keep in radar. So these are sort of conditional recommendations and not direct ones. There's a short covering seen in delivery today. Now, stock actually has reached its resistance level towards 264 odd levels. Now, condition is that if it's able to sustain above a 265, 266, it can head towards 278 to 280 levels. There is strong enough support seen around 256, so the condition would be only to wait out till it crosses the 265 resistance hurdle for the day. There's another selling stock that can be seen, which is in Bharti Airtel. Provided if it closes below a 1680 levels, there's a breakdown that can be seen in Bharti Airtel. Now, below those levels, it can retest its low support towards 1650 odd levels. So I think these two stocks can be kept in radar as much as the levels are concerned.
Bharti Airtel has been one of the most resilient stocks in the last 1 year. In the last 1 year, it's still holding on to a gain of about 44%. And from its 52-week high, it's up 43% at a time when the Nifty is only up about 3-4% from its, from the recent lows, the Nifty is up 3-4%. That's a 52-week low. But Bharti Airtel is up 43%. Thank you very much, Soni, for joining in. Get into a break. Here is some good news for all our viewers because India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. You can get instant access to breaking news, all our articles, financial world updates at your fingertips. So download the CNBC TV18 app now from the Apple or the Google Play Store, or you could just scan the QR code on your screen. Welcome back. Trend is a stock on your radar. 16-17% gone on Trend. This is the biggest single-day fall in more than 10 months for for Trend. Mangalam is now joining in with what they said in terms of their Q4 business update.
Well, it's a perfect storm for Trend, and that explains why the stock is seeing its biggest intraday fall since March 2020. That's the pandemic levels itself. And what are the three factors of this perfect storm? One, the market sentiment being weak. Secondly, in that the company has reported a weak fourth quarter update. And the third part is that valuations are also not conducive for Trend, despite the downtick that we've seen in the stock. What's important is that their fourth quarter revenue has grown by about 28%. Now, normally you would say 28% isn't bad in this current consumer environment. But remember, Trend over the last 3 years has been compounding its revenue annually at over 80%. Over the last 5 years, it's been compounding at over 35% itself. So when you compare it to its own historical growth, it is a disappointment. More than that, if you compare it to its own FY25 growth itself, FY25, the company's revenue grew at around 35%. So in light of that, this 28% seems extremely weak too. They've added more Zudio stores than the street was anticipating, and those stores were mostly back-ended in the latter half of the quarter. So them leading to growth in the next year is something that everyone will most definitely keep an eye out on. But remember, Zudio stores are margin dilutive for the company because they operate on lower gross margins. So, declining growth, increasing revenue coming in from margin dilutive business, along with high valuations. Trend, remember, at peak was trading at around 120, 122 times FY26 price to earnings. Now, with a decline of almost 45-50% from the peak, the stock is still trading at around 80 times one-year forward price to earnings. So all these factors coming in on Trend and causing the decline that we've seen on the stock today.
Thank you so much, Mangalam, for joining us and explaining to us what's actually caused an over 15% fall in Trend's stock price today. But moving on to another Tata Group stock, another stock that's seen significant selling pressure is Tata Motors with significant exposure to the US market. Sudarshan joins in with more details on the news development there.
So the news related to Tata Motors is the company has announced that JLR will discontinue its shipments to US market, which is one of its biggest markets, forming more than 30% of JLR's whole sales. Now, CLSA believes that the sales of its JLR products are in two brackets. First, 60% of that 30% comes in the bracket of $85,000. That price of that JLR sales that forms 60% is comes in the bracket of $85,000, for which the impact of this tariff is going to be limited. But the impact which is going to be major is for the range of products which is in the range of $50,000 to $85,000, where the major impact is going to be there. And because of that, overall 25% decline in the JLR volume can be seen. Whereas MS believes that this tariff hike, if it remains, it's going to impact the volume majorly. Also, there is a likelihood of free cash flow of JLR turning negative. Now, if these things, both tariff and free cash flow turning negative, happen, there is a case that the price of Tata Motors can slip as much as to 410 rupees per share, which is the bear case for Morgan Stanley. So it's not going good for Tata Motors because there is a tariff hike. Already Tata Motors has been facing the issues related to JLR in both European market as well as in the US market. But recently Tata Motors had announced that it will like to maintain its JLR EBIT margin of 10% for FY25 that company had announced earlier, which is now, after this tariff hike being announced, it's looking very like, it's not looking that company is going to maintain that margin level as well.
Yeah, tough times coming in for auto majors, particularly Tata Motors. The stock is halved from its 52-week high of 1,179. Stock today is at 560. But Delivery, the logistics firm Delivery has acquired its rival company, Ecom Express. Manglam joins in with the numbers.
Well, that's correct. So Delivery has gone ahead and over the weekend made the announcement of an acquisition of Ecom Express for about 1,407 crores. Ecom Express, of course, is in the business of e-commerce logistics, end-to-end solutions is what it provides. And can Delivery afford it? Yes, they had cash of over 5,500 crores as of the last reported number. So to that extent, 1,407 crores of cash is something that the company can definitely afford. More importantly, Ecom Logistics has done close to around 2,700 crores in terms of revenue in the previous financial year. So this aids Delivery's overall business as well. So the good part about this deal, and that explains why the stock is recovered from the lows, is one, Ecom's last valuation was well over $1 billion. So it's acquired this company at nearly 80% discount to its previous valuation. Secondly, the fact is that it strengthens its own positioning in the e-commerce logistics space, of which Delivery, ex-captive logistics, is anyway the leader. However, there are a couple of flies in the ointment. And what is that? One, despite a 2,600 crore revenue, the company is loss-making, the acquired company. They made losses of close to 255 crores. So how do they, come back in the black, and what kind of synergies can Delivery extract is something that we'll track. And secondly, nearly half of its revenues coming from Meesho, just one single large client, which also is looking at different ways of deploying its products, etc. So to that extent, there could be a bit of an important, overhang on that as well, and that could be a risk. So those are a couple of flies in the ointment. But all in all, it's a good deal for Delivery, especially given the valuations at which it was acquired.
Thank you so much, Manglam, for taking us through the contours of that particular deal as far as Delivery's acquisition of Ecom Express is concerned. But it's been a busy weekend for you. Godrej Consumer too reported their Q4 biz update. Tell us more.
Happy to report that both Delivery and Godrej Consumer are among the few stocks which are in the green today. Godrej Consumer, it had paid its dues in the third quarter itself, where the company cited weakness in overall business. Their volumes were flat. Their value growth was also very subpar, and we saw a big margin compression on account of high inflation in oil prices, palm oil prices, which are important inputs for their soap business itself. But then the company had promised that come the fourth quarter, their business would be focusing towards revival of volumes. Volumes have recovered, and that's why the stock has recovered from the lows as well. Volumes in the quarter in India in the fourth quarter have been mid-single digit, with high single-digit sort of revenue growth that the company is likely to report. Importantly, while palm oil prices are still higher and soap is still under pressure, so personal care revenues would be lower, we have seen mid-teens sort of volume growth coming in for their home care business, and that is likely to lift the overall volume for this time around. Their Indonesia business also is doing well. For margins this time, because the company has been investing in ads, investing in a lot of their marketing capabilities, etc., and the raw material prices have been higher as well. Despite that, the margins are likely to be absolutely flat in the third quarter. And overall, on a consolidated basis, which is on an organic consolidated basis, mid-single-digit volume growth and high single-digit value growth is something that the street likes, given what the company had reported in the third quarter, and also given the current environment in the consumer sector, along with the stock price decline that we've seen already.
Thank you very much for that. No respite for IT. The Nifty IT index is still down 4.5%. It's recovered a bit from the lows. At one point of time, the Nifty IT index was down 7% today. So compared to that, it's down 4.5%. But Kotak has come out with a note, and they're saying that what if there is a recession? And in the event of a recession in the US and some of the developed economies, this is the impact on Indian IT. Growth rates will be at -2 to -5% in FY26. In FY27, it will be just 1 to 5%, so feeble recovery. Currently, the base case is that they don't expect a recession, a full-blown recession, but so in their base case, they're now penciling in a low to mid-single-digit kind of a revenue growth. That will turn to negative growth in the event of a recession. They expect a higher decline for companies more exposed to retail, manufacturing, discretionary spending. They also expect margin pressures because if there is a recession, there will be pricing pressure. Companies will ask for discounts. So therefore, margins could come under pressure. And they've done the analysis of, say, EPS cuts, etc. And this is what the downside looks for individual stocks. For TCS, Infosys, we're looking at, and even actually in HCL Tech, we're looking at about a 20% downside. The stock price is compared to Friday's level. So today, again, stocks have fallen. So the downside may be a little less because today it's already played out. But we're looking at downsides of about 19 to 25% for some of the large cap. And the steepest one will be for two mid-cap companies, Mphasis and Coforge. And this, according to Kotak, perhaps is the bear case scenario. It's not their base case. But in the event of a full-blown recession in the US, as the market fears, then stock prices can head down by 20, 25, 35%.
And this after the kind of fall that we've seen in the last 3 to 4 trading sessions. That's right. Well, it's now time for a short break. We'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, once again, we are looking at the markets. There was a very brief respite from the selling pressure that we saw. And the small cap index had briefly gone ahead and pared some of the losses. But once again, it's a significant selling pressure that we're witnessing. As you can see on your screen, the mid cap index now from the daily high over 1% lower. And this is after a very sharp gap down open. The Nifty Bank index, that particular index is now down almost 3.7%. And in fact, if you look at the sectors, the Nifty Metal Index, that's the sector that's taken the maximum knock. Metal prices, commodity prices worldwide have seen significant selling pressure. Metal index now down over 7%. The Nifty Realty Index, that's another sector that's taken a steep knock, almost 5% lower today. The Auto Pack, as expected, almost 4.5% lower. The Nifty Bank so far was relatively insulated from the selling pressure, but both banking stocks as well as a whole host of NBFCs today have seen significant selling pressure. But it's now time for a short break. Again, we'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, it's now time for our special segment, Quarter Se Quarter Talk, where we bring you earnings expectations from each sector. Rima will tell us about how Q4 FY25 will be for the IT sector. Over to you, Rima.
Here's what the IT sell-off tally looks like now. Nearly 17% in the last 3 trading sessions and 27% down on a year-to-date basis. So it's a clear reflection of the macro uncertainty and the sluggish demand. Now let's get to the numbers for the March quarter. No major IT company is expected to report positive revenue growth in Q4. 0 to -1% are the estimates. So it's going to be a very soft quarter for the sector, and the macro uncertainty since the start of the year has only added to the seasonality, leading to delayed decision-making and tighter tech budgets. Let's get the numbers up for you on your screen. According to the CNBC-TV18 poll, TCS is likely to be flat, Infosys down nearly 1%, and the rest of them are likely to report a decline between 0 to 1% on a quarter-on-quarter basis. But the mid-cap IT performance, especially some of the high-growth IT companies, is likely to be much better. Particularly, it's persistent, Coforge and Mphasis, where you're likely to see a growth of about 3 to 4%. And for Mphasis, you could see the best growth in the last 3 years. But the fallout of the Trump tariff-induced macro uncertainty is going to hurt Indian IT, at least in the near term. We could see 1, delayed decision-making, Two, stricter, tighter tech, spending, budget cuts perhaps. And thirdly, the street was anticipating discretionary demand to come back in FY26, but that is going to be delayed. So with so much uncertainty, the risk is, what if the IT majors decide not to guide? Now, here's what Kotak said in their note last week. It may be prudent on the part of companies to defer guidance until there is more certainty on the demand environment, or restrict the guidance to the next quarter where there is a higher degree of visibility. But if they decide to guide, these are the projections that the street has put out. 2 to 4% approximately for Infosys, but there are some who believe it could be maybe 1 to 3%, 1 to 4% if they want to factor in a wider range given the uncertainty. JP Morgan is at 2 to 5%, slightly on the higher side. EBIT margins for Infosys seen between 20 to 22%. HCL Tech, again, seen largely between 3 to 5%, some may be at 2 to 5%, margins between 18 to 19%. And Wipro's Q1 FY26 guidance could range from -1 to +1. Now let's get to the sectors which are impacted the most and who has the highest exposure. We know retail, logistics, manufacturing, and companies like HCL Tech, Tech Mahindra, LTI Mindtree, and Infosys have higher exposure to these companies. Coforge, Persistent, Emphasis have a lesser impact, according to Kotak. Now, the big question is, after such a big fall in IT stocks, where are the valuations and are the stocks attractive? JP Morgan last week said, keep IT positioning light. Conservative guidance could drag the stocks lower, and that could create fresh buying opportunities. Kotak also cautions that if we hit a recession, there is more downside in IT stocks. If it's just a slowdown, there could be reasonable upsides. Now, the growth projections for FY26 are very muted. We're talking about like low single-digit kind of a revenue growth, and PE valuations are still a tad bit expensive on a relative basis.
Well, TCS will start off the earnings season with its results coming in on April 10th itself. Thank you so much, Reena, for joining us and giving us a sense of what exactly to expect from the IT sector this particular earnings season. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.